Hello, I'm Angela Palacios, Partner and Director of Investments here at the Center for Financial Planning. I want to take a few moments to recap what has occurred in markets so far this year and dive a little deeper into inflation. The S&P 500 logged its worst September since 2008, even a little worse than 2008, while a diversified portfolio has had one of the worst years on record so far. Fears of a recession and aggressive action by the Federal Reserve to hike up interest rates has caused the S&P 500 to fall back to levels not seen since November 2020 and re-enter bear market territory once again for 2022. The early days of the fourth quarter have brought some relief to markets, but continued volatility both up and down is likely to continue. Since inflation is top of mind for many investors, I wanted to spend a little more time focused on that here. Take a look at this updated chart of what goes into headline inflation. You can see the general trend is that it has peaked and now appears to be in a downward trend. I think this will continue in the months ahead. What is worrisome is the darkest blue part of this that is continuing to grow. This is how much it costs to own or rent a home and is considered stickier inflation. High interest rates should start to depress this number, but this could be slow to filter into the housing market. It's going to take a few months of higher interest rates and winter to slow this portion of inflation. Most of the surge in prices early this year came from transitory components related to supply-demand imbalances. Energy, new and used vehicles, and food inflation, really the green, red, and purple areas of this chart. You can see that those areas are getting smaller now, so inflation is coming down in those components, but could still be volatile. Service sectors like restaurants, hotel, and transportation, the light blue component, have seen some of the largest wage increases recently, and these costs usually get passed on to the consumer. So this portion of inflation could have a little bit farther to go. Sticky inflation is still strong and concerning enough to keep the Federal Reserve on its tightening track for now. Please check out our written commentary for more on other headlines like the Russia-Ukraine conflict, a very strong US dollar, interest rates and recession fears, and what this might mean for us. Thank you.